finally, home buyers are going to get a little bit of a break with today's update. This is update on news that came to the mortgage industry back in January regarding the new loan level pricing adjustments, or LLPAs. Okay, so these new fees and what loan level price adjustments are is a grid of pricing adjustments that underlies the interest rate. So rates change, right, based on a few factors, like how much down payment you have or what your credit score is. Well, they're adding a few more things to that, including how much your debt ratio is, so how high your debt ratio is. So this is part of this redesigned grid that Fannie Mae and Freddie Mac, the GSEs, government-sponsored enterprises, are putting together that's supposed to go into effect this spring. But a portion of that, the part about debt ratios, the mortgage industry has successfully pushed back till August 1st before it's implemented. So what does this mean to you? Okay, first of all, let's define debt ratio. So again, a debt ratio is one of the formulas, one of the measurements that we do as lenders to help you qualify for a mortgage, to know if you'll qualify for a mortgage and be able to afford a house payment, right, without it stretching your budget so far that you lose the house down the road. That's the last thing anyone wants, okay? Regardless of what people say that banks want to take your home, honestly, the last thing lenders want is to go through a foreclosure process and foreclose on a home. It's very expensive and time consuming, and there is zero guarantee that that's going to come out well for the lender, that they're going to actually make money on that deal. So what the FHFA is doing is saying, okay, we want to make sure people have, as little chance of going into foreclosure as possible. We have higher interest rates now. The economy is a little shaky. Let's make sure people are paying attention, right, to their budget and not pushing it too far. So if you spend more than 40% of your gross monthly income now, starting August 1st with this new rule, if it's more than 40% of your gross monthly income going out to pay your mortgage payment, including taxes and insurance, your car payments, your minimum credit card payments, student loan payments, and medical bills, things like that, if there's more than 40% of your gross monthly income going out to make those payments, you're going to pay more for a mortgage. They're going to charge you a higher interest rate. Okay, which is the idea here is to discourage people from pushing it too far. Okay, now I'm not against that. I think it makes sense. I mean, I don't like the fact that this rule is being pushed on everybody, but 95% of all the mortgages done in the United States are government-backed mortgages of one kind or another, most of those being conventional. So if that's the direction that we want to go as a country and have this, and which we have, right, for many decades now, and take advantage of the lower interest rates and inherent benefits that come from having fully government-backed mortgage industry, I mean, we have to unfortunately deal with and live with changes that the government wants to make with regards to the requirements to get those mortgages. Okay, so that's what's happening. So this debt ratio requirement portion of the LLPA changes that are going into effect this spring has been pushed back to August 1st. So what that means to you is, just in case you happen to find that home of your dreams during this time, right, when fees and interest rates might be less, if you act sooner than later, you may want to act sooner than later if you know that you have a debt ratio that may be too high or pushing the limits. So just keep that in mind. Now, of course, my advice is this, and I give this advice to my kids and my clients, right? It's best to work to be free of consumer debt in your life as soon as you can. So that way you avoid things like this, right? Surprise government fees aren't going to surprise you. It's not going to affect you at all. And by the way, it is possible to live debt free. Stephanie and I have made that a priority throughout our life together. It makes all the difference in how much less financial stress we enjoy, so we can focus on things that are more important and put our energy into our family and other relationships and just enjoy life more. So I highly encourage you to work to be debt-free of consumer debt as soon as possible. And then things like this won't even affect you, it won't even matter, right? So I've got a tool for you to help you with that. I have a link to a free debt snowball calculator. If you go to my Instagram page or my Linktree link here, you'll find a great debt snowball calculator that'll help you get out of debt sooner than later, and really get you on that path to a life of more financial freedom. So please do that, and don't forget to like and subscribe to my page and my channel here. We'll talk to you soon.